Great. Thank you everyone very much for coming. It is 1 o'clock, and so we're going to go ahead and get started. My name is Emma Summers-Roy. I'm the Chief Investment Officer at Mass General Brigham. I am very excited to introduce you to our panelists today. So to my right is Letitia Johnson. Letitia is the Chief Investment Officer at Amherst College, and prior to joining the college, she worked at Cambridge Associates. She has an MBA from the Yale School of Management and a BA from Brown University. She also currently serves on the investment committees for both Boston University as well as Mass General Brigham. To her right is Paul Mace. Paul is a managing director with Williams College's investment office. He has been there since 2023, and before that, he was at Tufts University for
almost 20 years.
Almost 20 years. Paul has an MBA from Babson and has a BS from Trinity University. And then at the end of the table, we have Adam Posner. Adam is co-head of public markets at HighVista Strategies. He is also a partner at the firm. And prior to HighVista, which he joined in 2016, he was at Harvard Management Company, where he focused on public markets and absolute return strategies. He has a BA from Middlebury College and also an MBA from Harvard Business School. So we are going to start off going down the line. I was hoping that each of the panelists could chat just real briefly about the institutions that they work for and how they think about success metrics for those pools of capital they manage.
Start. Okay, thanks, Emma. Hi, everyone. Great to be here. So Amherst College, and I don't want to steal a lot of thunder from Paul because it's very similar to Williams College when it comes to investment objectives. But just the very quick, the quick and dirty on endowment investing for a place like Amherst is it's a $4 billion pool. We spend between 4 and 5% of the endowment every year to support the operating budget. And that 4 to 5% is about half of the operating budget for the school. So it's a really important asset in the financial model of the school. And from an investment perspective, the goal is to source that spending every year and grow the assets so that you maintain the real value of the corpus, which is inflation plus the spend rate. So we're trying to earn high single digits on the endowment over decades. It's meant to last in perpetuity. And we do that through investing in a set of managers, like biotech managers, healthcare managers, or generalist managers that invest in healthcare. And we have about 40 of them across the entire endowment. And we invest in managers for, the goal is for decades, but the average duration is 15 years in our portfolio. So that's the very quick story on Amherst.
That's a great summary. So Williams College, very similar approach to our managing our portfolio. We manage a pool of about $4.4 billion, which is two components, the majority of which supports the college. Almost 60% of our operating budget comes out of the endowment, so pretty significant piece of the puzzle for Williams. And then we also manage a separate pool for the Clark Art Institute, which sits next to Williams campus. It's under a single asset allocation. As Letitia said, we're 4 to 5% every year we're sending to both the Clark and to Williams. And I think it's key to kind of leverage the long-term orientation of an endowment. I think that's part of why we set an allocation that's equity-oriented and has an appreciation for alternatives and kind of the value that can bring to the portfolio from a return perspective, but then also an understanding of the liquidity required to invest in some of these asset classes long-term. So.
Great. So HighVista is a Boston-based investment firm that today manages around $11 billion on behalf of institutional investors, so think pension funds, sovereign wealth funds, small endowments and foundations, as well as family offices. Our goal is a bit different. We think our primary reason for being in business is to generate alpha for our clients, and we think the best way to do that is by focusing on inefficient markets. And so biotech is one that we have very high conviction in. We think that it's inefficient because we want inefficient markets because we think if you do that, there's a higher ability to outperform, and the outperformance is much more likely to be persistent, which is otherwise scarce in public markets today.
Great. So that actually gets us to the next question I was hoping to ask each of you is how healthcare fits into your whole portfolio. So I don't know if, Adam, there's anything you wanted to add there. Otherwise we can.
Yeah, sure. So of our $11 billion, so you should think 30% of that is in public markets, and then about a third of that is in biotech. So biotech is a very big and important area for us. We have close to $1 billion invested in the sector today. And so for us, it's a big bet. We think it is the most attractive place in public markets to generate alpha. And the reasons for that are several-fold. So one, it's both simultaneously big and small. So there's, call it 600 companies in the biotech, publicly traded companies in the US in the biotech sector today. So nearly 1/6 of all companies that trade are biotech companies, which is pretty amazing when you think about it. But individually, they're tiny. They're a couple $100 million market cap on average. And so small companies generally aren't covered well by the public markets. Large pools of capital have a hard time investing there, and so that gets our attention. But I'd say primarily it's the dispersion that you see in biotech that really stands out for us. Dispersion in biotech is roughly twice that of all other sectors, and it's probably pretty obvious, but what makes that true is there's kind of this constant flood of idiosyncratic binary events that cause stocks to go up or down a massive amount, which just isn't true, generally speaking, across the public markets. And dispersion is super important for investors because every big move is an opportunity to be right or to be wrong. And so to pick off winners, to identify losers by being short, every move is an opportunity. And so that's, I guess, really important for us. And then the last thing I'll mention is relative to all other spaces in the public markets, specialization is the name of the game in biotech. It requires incredible domain expertise and specialized knowledge to even have a chance at investing well in the space. We like to think of just kind of the side-by-side of a smart investor looking at Home Depot and also looking at Abivax, and like which one are they more likely to get right? And it's just night and day in biotech relative to other parts of the market. And so for us, that's compelling because it's hard for most people, it creates a barrier to entry, it keeps out capital, it keeps out competition, and provided you can find good firms and good strategies, there's more alpha for you to keep to yourself.
That's a good summary.
Yeah.
So from William's perspective, I was looking at the numbers this morning actually. Healthcare is about 8% of our portfolio overall, which I'd say is in line with the broader equity markets. I think we bench our equity returns to ACWI, and it's about 8+ % in healthcare. Actually, the lion's share of our exposure has been on the public side, and I've been trying to kind of add some incremental things on the private side because we think there's a lot of opportunity there, both in life sciences and also in healthcare services, where we think there are a host of interesting managers that we could back in that space that we think can take a long-term approach and really generate some alpha in our portfolio. As I look at our portfolio today, we have a number of things. Contract manufacturing on the healthcare services side, several medical device companies that we think are bringing some, interesting new products to market. We've also, there's been this convergence of technology with biotech, so tech bio, for lack of a better term, is definitely, we're seeing that on the venture side of our portfolio. As Adam said, I think specialization and expertise is kind of critical to execution here. So that's a big part of our process, is trying to underwrite that skill level at the manager level. So yeah, I think there's a good amount of opportunity here. We'd like to probably increase our overall healthcare exposure over time, but we're not really making a necessarily tactical bet. It's very bottom up in evaluating a manager's ability to kind of execute the stated strategy.
Yep. Great. So similarly, I checked our healthcare exposure this morning, and we've got 11% of the total portfolios in healthcare. And I'll just bring in the whole theme on specialists and generalists and sort of our approach to healthcare. So we've got these 40 managers across the entire portfolio. We generally, we are concentrated very much on purpose, and when you have that mandate, which is, it's sort of a very high bar and an incremental manager, we're going to prefer a generalist approach to a specialist approach, all else equal, because we think it creates more endurance in strategies. It's very hard to call a sector for a long period of time. So the sort of weight of the portfolio tends to focus on generalists, but we will, by exception, invest in specialist managers. And biotech, to Adam's point, is an incredibly rich opportunity set, both for alpha as well as sort of just general tailwinds in terms of innovation and value creation in the sector. So we have, of that 11%, over half of it is in generalist managers that have chosen to invest in healthcare. So whether it's a private equity manager that has a healthcare focused team that makes, healthcare investments on behalf of that private equity firm, or a public equity manager that will go and buy, Pfizer or Lilly or whatever it might be. That part of the portfolio will go up and down, and it can go up and down significantly over time. I think it's funny that our numbers are actually quite close, even though we get there in very different ways. So that's about 6% of the portfolio, and then we've got another 2% in specialist biotech investors on the public side, and 2.5% on specialist biotech investors on the private side. And there it's a very organic, just looking for managers that we think, despite being very focused on a specific sector, have an opportunity to build an enduring track record. And we're hopefully with them for decades, but that's the lay of the land on how we invest in.
Thank you. And just a terminology point, you've heard every person here talk about managers. So as Letitia was just describing now, when we talk about managers, that is private equity firms, venture capital, long only, long short. But including MGB, every group here, our primary focus is on selecting groups like those to then ultimately access the securities and assets at the end of the day. With the goal knowing that those groups are that much closer to the assets enables all of us to access opportunities that are rich and hopefully have really attractive risk-reward skew, but also global in many cases. So to that end, I was actually hoping to then touch on how you think about specific attributes you look for in the managers that you invest in. So maybe, Paul, we could start with you. And I should have noted too, Paul spends most of his time on the private side for Williams. So it would be great if you could chat a little bit about that on the private side.
Sure, happy to, Emma. So on the private side, I think there are some specific things that we're looking for as we're evaluating managers. As I think about life sciences, a lot of the strategies we look at are therapeutics oriented. I think having scientific and sort of technical expertise matters quite a bit. It's sort of table stakes to some degree. Like I think most groups need to have that to be able to kind of really evaluate deal flow and some of the product portfolio gaps that large pharma may have. I think strategic knowledge of where those gaps lie and the ultimate market potential for a drug are something that I spend a lot of time, talking with managers about and kind of understanding, the depth of that knowledge and the depth of that network that they could tap into to kind of execute there. I'd say the other part is really around the relationship network around talent. I think you saw this period recently where a lot of companies got funded. There was a lot of private capital that backed biotech, and there was a real talent gap. So I think managers' ability to kind of both attract talent and align interests with talent is kind of a critical part of executing and driving returns for investors. And that's easier said than done. I think there's a small handset of people that actually can do that. So that's really on the therapeutic side. I'd say, as I think about more broadly our healthcare exposure, as I mentioned, we'd look at a bunch of buyout and growth managers that do healthcare services. I think having some operating expertise there matters a lot. If they run a company in the space, do they have the relationships with providers and regulators that we think, is durable and also gives them maybe a unique insight as to, what's working and not working in the current system and how can you take advantage of that with a new business model. Mm-hmm. I think all of those things are things that we're, doing during our diligence session. And then I think, as we all discussed here, we're trying to take a long-term approach here. So really trying to understand a manager's motivation for building the business and what are they trying to do longer term, right? Why are they in this? Why are they doing this? Is there a passion behind, what they're doing and are doing it for the right reasons? I think are things that we look for.
Great. Adam, would you go on the public side?
Yeah, I would say that there's 3 things that are kind of must-haves for us. First off, we want kind of boutique specialists. Like we're not interested in generalists, healthcare generalists. Like we want people that all they do is innovation, biotech innovation in the public markets. And oftentimes these are tiny firms. Like we'll be investing when they have 2 or 3 people on the investment team. A big team would be 8 people. Like we want firms that all they do every day is innovation in the public markets. We also care a lot about being well-sized for the opportunity set for what they're doing. So we put huge value on the ability to be nimble, the ability to change your mind, the ability to double down, and not be kind of held back by the constraints of either the size of the funds you manage, the liquidity of the stock, or your stake in the company. We think that small is better than big in biotech for the most part. And then I'd say we also care a lot about the life cycle of a firm. So generally speaking, we want to be investing as early as possible. So we're not looking to back people with no experience. It's the opposite. We want to back people with decades of experience, but the first time we can, usually their name's on the door for the first time. They have skin in the game. They have a lot to prove. They're super hungry, and they're still small. So you're very well incentivized with them to do incredibly well from there. And then lastly, it's not at the manager level, but we have, I think, 9 specialists that we're invested with today. And so as we're evaluating the next one or thinking about changes to our portfolio, we really want to understand how they interact, how they fit together, where are they differentiated or where are they overlapping? Because at the end of the day, we're trying to deliver kind of a cohesive portfolio rather than look at each manager on a one-off basis. So we try to make sure that we, every once in a while, zoom out and make sure that everything makes sense on that basis as well.
Great. And then, yeah, Letitia, you spend obviously both time with the managers directly, but also thinking a lot about portfolio construction. So is there anything you would add relative to your comments earlier?
Yeah. Yes, I would say, picking up on what Paul and Adam were saying there, we look for different, where you play in these markets very much informs what we look for manager by manager, whether it's public or private, healthcare services or biotech. And then there's some fundamental things we look for across all managers: high quality people, incredibly good referencing, and a demonstrated ability to add value. I think one of the more interesting things that we've been discussing a lot as a team, and we'll probably be getting into this more later as we talk about the current environment, is the trade-offs that you get when you think about a specialist manager that's very focused on biotech or any other space versus a generalist manager. And what you're getting with one versus the other. So on the generalist side, you are getting the ability to pivot and to give us some intelligence about relative opportunity sets across the landscape. When we have only 40 managers in our portfolio and it's an 8-person team based out of Boston, we cover the entire global investment landscape. We depend a lot on our managers to give us intelligence and information about what is attractive. The problem with just having generalists is, to sort of all these points that Adam and Paul have been bringing up, they're not well equipped to invest in biotech. So you can say that, and then you have no biotech in your portfolio. So there's a decision point there where we have to say, well, we want some biotech. There's a lot of pressure, by the way, on that single decision. Is that the right decision? And so what we've been talking about a lot now is you have these sort of 2 very contrasting thoughts. I want intelligence on what to invest in for my generalist managers, but they won't invest in biotech, so how do I make that decision? And what we think about a lot with our biotech managers is making sure this doesn't have to be throughout the entire organization, but at the leadership level, that the people who are making the decisions about how to prosecute the strategy know what it is we want, which is ultimately great long-term returns. And it sounds super basic, but it's actually incredibly important and not always there. So that's something we've been talking a lot about recently.
Thank you.
Yeah.
So now pointing to the current environment, Adam, I was hoping we could chat a little bit about what has been a pretty volatile environment. So you noted earlier that in any individual stock, particularly in the biotechnology space, volatility can be very significant, but we've even seen this in the broader market. So could you chat a little bit about whether this is an opportunity or a challenge, and if it has any implications on how you think about managing your portfolio?
Yeah, so it's definitely been a challenge. I think if you look back over the last 5 years or so, biotech basically is flat while the broad market's been up 100% or more. So in hindsight, it's been very challenging, and I think a lot of people are throwing in the towel. But we try to go a level deeper and look at, okay, when you strip out kind of the bad, all the headwinds that the space has faced, whether it's macro, certain regulatory things recently, we've continued to see very strong alpha generation across our portfolio. So if you looked in the last 3 years versus the 3 years prior to that, we're still outperforming by the same magnitude in both both time periods. It's just that the market tailwind has basically become a headwind. And so for us, that's interesting because we think that the fundamental thesis of biotech being inefficient and alpha-rich is still intact. And it feels, I mean, it's easy to say, but it feels like we're kind of at a very asymmetric moment where you're able to make great investments because capital is scarce in the space. And hopefully as the long list of risks come off the table, as people become less worried about the most draconian scenarios, you get paid well for that. So I think that's kind of how we think about investing today, but there are, I would say, modest tweaks that we've made to our process and our portfolio, just given the backdrop. One, I'd say, is we're trying to be a bit more diversified, just acknowledging that there's always things that you can't rule out and risks that you can't price, and just trying to be a little more diversified to acknowledge that. I would say we're trying to be more active in kind of comparing the different portfolios and opportunities that our specialists have today, and then really leaning hard into the ones that we think are the most interesting. And then the last thing I think is we're trying to be sharp about we're trying to be sharp about kind of our own partners and the businesses that they're running, and making sure that they're able to play offense, they're able to be thoughtfully aggressive, rather than playing defense because they have big redemptions or other things that can be an issue, especially with the smaller firms that we tend to deal with. There's definitely more business risk, so we need to kind of double check that before we double down.
I was also hoping to talk a bit about time horizons. As we all know, many healthcare discoveries have long paths to both proof points and ultimately commercialization, but many investors can't see through an investment all the way through from the beginning to end. So maybe actually, Paul, could you chat a little bit about how you're thinking about that on the private side, maybe on the early stage, anything that helps mitigate potentially long time horizons or ensure that your managers can see them through to those ultimate outcomes?
Sure. Yeah, this is probably one of the biggest challenges in early stage biotech investing is the time horizon. It's very uncertain. You tend to have binary outcomes where you can lose all your capital, and how do you kind of manage capital efficiency is definitely a challenge for managers. I think what I look for here is really managers that have a good understanding of controlling costs on the clinical trial side. And they can do that in a bunch of different ways. They can do that through shared kind of, scientific resources. Like a good example locally here, the folks at Lab Central, they incubate a lot of ideas out of places like that where they can control their costs. They have industry partnerships where they can get something to proof of concept faster and more affordably than maybe some other companies. I think the way investors do that, they have to take larger ownership positions. So I'm attracted to kind of strategies where they have an understanding of that and an understanding and ability to kind of manage it more tightly than some other companies have historically. I think, I mentioned earlier this concept of investing in talent networks. I think being able to recruit talent and build teams quickly and cost efficiently and aligning those from an equity ownership perspective is a skill, and a skill that's important, particularly in biotech. So again, that's something that we spend a lot of time trying to understand and assess. I think leveraging non-dilutive capital as best you can. I mean, that's gotten more challenging more recently with what's going on in Washington these days, but I think there's still opportunity there for companies to kind of leverage that, either from industry or from academia, or some of the government programs that are still available. I think that's, again, you have to be able to navigate that in a way that's additive. And I'd say, just overall, it's a timeline that certain types of investors can tolerate and others can't. So aligning your pool of investors in a way that doesn't create conflicts is important. So one of the things that we look at when we back a new manager on the private side is like, all right, who's around the table with us? Not so much that I'm trying to validate the thesis necessarily, but it's more about projecting how are they going to behave in different market environments, and are they going to be truly committed to kind of ride through some volatility? Certainly what we've experienced more recently here, is testing the bounds of that in certain managers. So.
And then Adam, this may go back to the volatility conversation, but we also see the rise of relatively short-term behavior in the public markets as well, and specifically some of the quote-unquote pod shops that are more active these days. I don't know if that has what your thoughts are on there, any implications you see in terms of how you think about investing.
Yeah, I think it's definitely a factor. There's no question that one of the biggest themes in the public markets over the last 15 years probably has been the rise of the multi-manager firms, which have attracted a huge amount of capital. And they definitely have a different approach and time horizon than the traditional specialist firm that I think everyone here prefers to invest with. At a high level, their strategy is to generate lower returns, use a lot of leverage, and then have tight risk management on top of it. And so overall, this makes them hypersensitive to volatility, which in turn can cause more volatility if they hit a risk limit and then need to take exposure down across their portfolio. So similar to what Paul was saying, we think it's increasingly important that we're just kind of cognizant of the other factors around an investment. So who else is in the company? What is short interest? How illiquid is it? And just other non-fundamental factors that probably don't really matter for over the long term, but can matter a huge amount in a given day. So I'd say overall, we think as long as you have the time horizon and the partners that you're with have the time horizon and capital base to ride it out, it can be a great opportunity to add more to some of your favorite positions at lower prices. But it's definitely been an adjustment for folks, and it's also a distraction, so you can't say it's not a factor.
So Letitia, everyone here at the table is a long-term investor with a very long time horizon, but we are also grappling with short-term challenges, whether that's what we've just discussed or also on the policy side, on other types of funding. So how do you think about that when you are making active decisions today in terms of where to allocate capital?
Yep. So I think the first thing I'll share on this is, and I didn't share this at the beginning, but we have these 40 managers, equity-oriented portfolio. About half of our managers and our assets are privates. And then we have to spend 5% every year. So managing liquidity is a huge part of what we do, and involved in managing liquidity is sort of normal course management of liquidity and then tons of stress testing. And so when we think about allocating capital, and I mentioned liquidity because that's a huge, there are two key components to how we think about committing to a manager or investing in a manager, and those are the bottom-up conviction that we have in the individual manager, and then any kind of top-down constraints that we might have, whether it's, do we have a ton of biotech in the portfolio already and we want to limit our exposure there? That is not the case, but it could conceptually be the case. Most of the time, though, the major limiting factor from a top-down perspective is liquidity management. So we're very careful around position sizing there. The more recent, the first 6 months of this year, my life was completely dominated by the endowment tax. And I mention that because that's clearly part of what you're asking about. And that was actually a very, colleges and universities tend to be, and you all know this because so much of the research comes out of this space, so you guys are intimately familiar with this sphere, are designed to be very stable organizations. So dealing with what was potentially actually for both of our schools at one point a 21% tax on our endowment, basically returns is how you can think of it, and then an 8% tax, was a hugely, very big, would have been a step function change to the way that we thought about the finances of the college. Less of a step function change in how we invest, but certainly from a demand side, demands on the endowment from a funding perspective, there would have been a lot of tumult there. So we don't usually deal with something of that magnitude. Anticipating that was a ton of modeling, not a ton of action. We actually we are not taxed now because we're a small school, which we can get into if there are questions. But the answer directly is we do it extremely carefully. And the idea, because we are meant to be here forever and we're trying to be in these managers for many, many different funds and hopefully decades, is we are committing with that in mind. So we actually do. We have like 5, 10, 20-year modeling in terms of, at this pace, what would this manager grow to? Knowing, of course, that it's a complete and utter guess, but there is a framework for thinking about position sizing and commitments with the absolute intention that we are going to commit for a very, very long period of time.
Yep.
And I think that's sort of like, that's, you know, what a difference between that and the pod shops.
Yeah.
But yeah, that's the goal.
Thank you.
Yeah.
And I should have noted at the beginning, we do have a live Q&A function. So if you have questions, you're welcome to submit them. This question that came through, I think you kind of just addressed it, was about the fact that neither Williams nor Amherst have a large research presence. So unlike MGB or Harvard itself, your endowments primarily support undergrad costs. Does that alter your portfolio and liquidity compared to groups like MGB? And I think you largely, I don't know, Paul, if there's anything you would add to address that.
Yeah, I mean, the endowment tax was potentially hugely disruptive to Williams, you know, similar to Amherst. We didn't really rely on the government for research dollars, right? So we're somewhat unique, I guess, in that respect. So the uncertainty around those longer term cuts are much more of a challenge for the larger research universities, and, you know, hopefully get some more clarity on that. I mean, you know, obviously, beyond just being disruptive to the investment model, you know, there's long-term questions around, you know, what it does to the economy and kind of innovation broadly. So yeah, we weren't terribly exposed there, but ultimately, you know, I think we want to try to take a long-term view beyond the short-term politics of where the opportunity set is. And I think ultimately some of the factors that have us excited about healthcare are still there, right? We have an aging, you know, demographic globally. We've got, you know, technology having a really interesting impact in many different areas of healthcare. You know, you've got large pharma companies that have real strategic issues around patent roll-offs. So, like, all of those things are interesting, and, you know, you sometimes need to take a step back and not think about what's on your Twitter feed or whatever. Like, it's sort of separating the short term from, like, the long-term investment horizon is something we spend a lot of time talking about.
Yeah.
So.
Another question that is for both of you was, do alumni connections to a company influence your decisions at all?
I can start that. First of all, if there are any Amherst alums in the audience, I'd love to meet you. The Amherst, it's a small but mighty alumni base, and I actually think that's an incredible. It's sort of like a superpower because you actually can wrap your arms around it. So we are very intentional about making connections with the alumni base and investing, as well as within you know, biotech for sure. We try to do that as well. So I actually am completely serious. I would love to meet any alums in the audience. It does. I wouldn't say it. No. The short answer to that is kind of like no, but also yes, in that so much of our work is focused on getting to know people and building conviction in the leadership of a firm, in the talent that they are recruiting, and how they are going to manage this firm over time. So any way that we can get to know a firm better is great. And if you're an alum and we can get to know you better that way, that is terrific. But it is by no means a requirement, nor is it a leg up, only in as much as, like, if we have some connection and we can talk more, that is terrific. But the answer is kind of basically no, but we love our alums. Yeah. I don't know if you
Yeah, I think a similar answer. I mean, look, Williams has a really robust alumni community, and they're very loyal to the school. You know, I look at it from a diligence perspective. Like, I love to cultivate a diligence network, so I actively do try to, you know, meet as many Williams alums that I think, you know, can be helpful and relevant, and that's pretty broad mandate. Like, we've got a lot of different areas where we're invested in the portfolio, and any place where we can leverage them, you know, I'm all ears. You know, we definitely have invested in firms that have some sort of Williams connection, but it's certainly, in some respects, it creates a higher bar because you know, it has to stand on its own from an investment perspective, and then knowing that there's this connection, while could be helpful, is also something that, you know, as a fiduciary, we've got to take seriously. So
yeah, one thing I would just add on this that may not be obvious from people who don't sit in our shoes, but it is a very weird job to have to evaluate a firm from the outside.
yeah.
and there's a lot of sort of friction in that relationship, and there's resistance for a very good reason, to letting people completely inside in terms of knowing what's going on at a firm. So the more that you can cultivate, as Paul said, these networks of people who will tell you what is actually going on, it makes our job so much better or so much easier, and we can know these firms a lot better. So any way in is incredibly valuable.
Yep.
I do want to jump to current focus areas as a result, or maybe in the context of the current environment. And perhaps actually, Adam, we could go to you. So given the environment in which we are in today, are there specific styles, specific therapeutic areas? Like, how are you thinking about opportunistically leaning into various, again, strategies or end markets for your portfolio?
Sure. So I would say that one investment that we made recently, which I think will directly answer your question, is with a firm that basically only does structured investments in pipes and companies that basically have been left for dead. So if you think about it, over the last 5 years, or 5 years ago, a lot of companies went public maybe a little too early for the public markets, and the market environment changed substantially. And so many of these companies, the stocks are down 95%. In many cases, they're trading at negative enterprise value today, so they have more cash than market cap. And they've made fundamental progress, but no one really cares at all. And so at this point, they're facing some financial distress. They need capital to continue their programs. So the partner that we're with, and we're seeing other people do the same thing, they're effectively creating transactions to infuse capital into these companies. Their capital is scarce right now, and so they're able to charge a very high rate for that. So you should think about getting extremely attractive warrant coverage, being able to stage the investment so that if they're not putting it all in on day one, and just other really juicy terms and features that you don't see in a bull market. And so we think these are individually really compelling investments. It doesn't mean that they're going to work out in the end, but we think that deploying capital in these sorts of structures is extremely attractive, and we're super excited about that.
I don't know, Paul or Letitia, if there are specific things you would highlight that have piqued your interest.
Yeah, in the beginning I mentioned we're very bottom-up focused in terms of how we're evaluating things. I would say, continue to think there's opportunity on the venture side of biotech with the right managers, right? I think that's the challenge, is getting allocation and, the cycle right there. So definitely focused on building out a pipeline there. It can take a long time. We could be tracking a manager for a number of years and get to know them before we actually make a move to, allocate a new commitment. And then I mentioned earlier, healthcare services, definitely building out a pipeline of, buyout and growth equity firms that have healthcare expertise on the services side. It's definitely an area of interest. Continue to think there are tailwinds there. And, as I mentioned, groups that have strong operating experience and an ability to kind of, bring the providers and the patients' experience into their business model are things that we're focused on there. So I don't really have targets. It's more of a balance from a bottom-up perspective. I would expect probably longer term, we're fairly balanced between venture and life sciences and healthcare services as I think about it, but it's not a hard target in any. It's really finding the right connection with the manager and their strategy.
I would just add on the biotech side, sort of to Adam's point, I always think this way, so it's kind of unfair to make it as like a current environment thing, but I do think the current environment argues for, if you're only going to have one manager, make it a flexible manager.
Right.
Because the environment over the last 5 or 6 years has changed quite dramatically, and the ability to flex where there is opportunity is really important. I think this pipe example is a great one. There's so much volatility in the space, and having the flexibility to go where you think it's attractive is important. The other thing that I will just emphasize, and I think one of us has said this already, is the importance of the LP base today is almost more important than ever. Because it is hard, for some strategies right now, is incredibly hard on the fundraising side. So having LPs that stick with you and can see through the strategy in what should be a very attractive long-term investment environment is critical.
So we have about 30 seconds left. There is one other question to that point that I thought we may want to hit on. Do you prefer to be an early investor with bigger long-term returns on less money, or a later investor with a shorter but larger monetary commitment? So basically, as you think about the time horizon for your relationships, what's a priority for you? And maybe Letitia, you
Sure.
could close us
That's
out
such
on
a
that.
good question. I mean, so yeah, I think I mean, well, I'll just like rephrase the question because there's really no good answer. The question is, do we want to have a small investment in something that's going to make a 10x, or 5 times that much in something that's going to make a 2 or 3x? There are a few ways to answer that. One, first of all, is that whatever returns it is you're generating, they'd better be appropriate for the strategy that you're looking at. So it needs to be a high quality return. For reasons we haven't really gotten into, we have this concentration. We really don't want to have a ton of managers. We think it makes us better investors to have fewer managers because we can know the portfolio better is really the short story there. So we think a lot about this question. We're not going to go out and buy it, but we're not going to go out and do all the amazing work that Adam does and pick 10 biotech managers. So the ability to invest at greater scale is extremely important to us, and I would just say it's a major balance that we sort of face all the time. And there's no sort of silver bullet answer on it. I don't know if you guys would.
No, I would agree with that. We're not building sort of a fund-to-funds model here. Like, it's sort of got to have real high conviction in anything net new we're putting in the portfolio. I mean, I think we are probably more multiple driven. If it's more of a question around being multiple driven versus more IRR driven in our approach, I think we definitely are taking a longer term multiple view. I mean, I'm hoping I can generate large multiples on the full commitment I'm making, right? However big or small. But yeah, I think that's sort of how we think about it. Another one, a related question that has a more clear answer is, would you do something that has a slightly lower return but a much longer tenure? Mm-hmm. And the answer to that is 100% yes. Yeah. So that's an easier question. Like, we're not going to do something that lasts 3 years. It's not something we're interested in doing. Yep. But we are very interested in doing something that will last 30 years, and if it's a little bit lower returning, but the opportunity set is more enduring, we will absolutely do that. Yep.
Well, we are out of time. Thank you so much for coming. Thank you very much to our panelists for joining us. I really appreciate it.
Thank you, Emma.